Good morning, everyone, and welcome to the monthly economic briefing presented by the Kenan Institute of Private Enterprise at UNC Kenan-Flagler Business School. I'm External Affairs Associate Rob Knapp. It's great to have you with us this morning. So we have a jobs report. Jobs report says 199,000 jobs added, which is a touch over the median estimate, but that number may also be a little bit misleading. We're going to talk about that jobs number. We're going to talk about inflation. And our presenter, Greg Brown, who'll be coming up in a moment, has been keeping an eye on the markets post-release of the jobs numbers. So a lot to get to. First of all, let me give you some rules of the road. Greg is going to talk for about 15 minutes. Then we'll do about 15 minutes of taking your questions. Please submit those at any time during the briefing by using the Q&A function at the bottom of your screen. Any of you in the media, please list your title and organization with your question, so we'll be sure to prioritize those. If you're joining us by phone today, you can ask a question too. Please email that to me at rob_knapp@kenan-flagler.unc.edu. We're going to try to get to all of your questions before we close this down about 9:30. If you get too close to 9:30 with the questions, we might not. So just a warning there. So let me get to the intro. Back with us today is Professor Greg Brown, finance professor at UNC Kenan-Flagler, and until he steps down back in August, was our executive director. Greg, good morning. Good to see you.
Thanks, Rob. Yeah. As always, it's fun to unwrap the employment report. It's like Christmas coming early to look at all the little exciting presents inside of it. So spend a few minutes just talking about some of the details of the report, and then we'll kind of dig into discussion about inflation. And obviously, there's been a lot of discussion about inflation coming down. Is the Fed, is it mission accomplished? Is there more work to do? Clearly, the market has a view. The Fed has a view. We'll try to unpack this a little bit and think about how to potentially reconcile some of these conflicting views, or at least have our own opinion on it. So I'm going to go ahead and share my screen here. So the employment report was a good one, I think. The change in non-farm payrolls was a little bit above the expected value, so 199 versus 186. That said, the prior months were revised down a little bit over the last couple months. And then also, if we look at just the private component of the non-farm payrolls, it came in at about 150, which is maybe a little bit below expectations. So, of course, the difference being what government employment was estimated to be, and it was a big jump in government employment. So other places of strength in terms of industries and sectors. So a lot of the job gains came in healthcare and hospitality. And so we think about the combination of those: healthcare, hospitality, government. I mean, these are industries that had been struggling to hire people over the last year or so, maybe with the broader labor market sort of slowing down a little bit, especially manufacturing sector and tech. A little bit easier for them to get back up to employment levels that they've been seeking to get to over sort of a reasonably long period of time now. So you can think of this as being sort of maybe stabilization in the labor market. We're moving from sectors that were too hot and companies struggling to hire at their desired level to something that's kind of maybe closer to an equilibrium. We did see a nice bounce back in manufacturing. Some of this has to do with folks coming off strike, and that sort of right in with expectations there. As was the increase in average hourly earnings. Weekly hours ticked up a tenth, and overall, I would say that the establishment survey, the one that asked businesses what they're doing, was reasonably strong on the employment side, and a bit stronger on the wage side. So wages overall, if we look at sort of the total amount of compensation that was estimated to be brought home by workers, it was a very healthy gain in November. Now, if we go to look at the household survey, remember that the Bureau of Labor Statistics does two surveys, one that's of businesses and one that's of households. And the household survey is smaller, but it lets you get the unemployment rate because businesses don't know how many people are unemployed. You have to go ask households what their employment status is. So this was a very strong report. I'm going to jump forward a slide here. So we actually had an increase of 747,000 jobs according to the household survey. This is a noisier survey because it's a smaller sample. Oftentimes you see much bigger swings in this data. And so you got to take any given monthly number with a grain of salt. But that said, this is going the other direction from what a lot of people were expecting. There was a lot of folks that were saying, hey, listen, we may have already entered a recession, unemployment rate may be ticking up. And we saw the opposite. We saw a very large increase in jobs, very large increase in the labor force participation rate ticked up, and consequently the unemployment rate dropped from 3.9% to 3.7%. And again, this is just within a hair of the unemployment rate's all-time low. So the graph I'm showing here is the kind of broader measure of unemployment that includes people that are marginally attached to the labor force and working part-time for economic reasons. And again, it's off its lows from earlier this year, but just barely. And again, those lows are essentially post World War II lows in unemployment, just about as long as we've had data. So again, a little bit of a conflicting view coming from the household survey. It's less reliable, but a very strong report compared to what is a reasonably strong report from the establishment survey. So, I guess I'm going to characterize this as slowing slows. So we've definitely seen, a downward trend in terms of employment gains. So, but they're still gains. And that slowing seems to have basically kind of tapered off. We've been kind of up or down on the 3-month trend. That's the orange line on this graph. And so, we're kind of back at a rate of an average monthly payroll gain of around 200,000. And that's a lot, right? And when you think about what demographic trends are in the US, 200,000 a month may be not sustainable, right? That may be more than the economy can sustain, and essentially not go back to sort of an overheating type of mode, and not and prevent the Fed from cutting rates. So I think there's a debate right now happening in markets and among economists. Are we headed for the Goldilocks soft landing? I think the bond market has been cheering that outcome to some extent. Certainly, there's been a big rally in stocks that sort of suggests that the Fed is going to avoid a hard landing. And I think we need to kind of consider, like, is this most recent data consistent with that soft landing? The alternative, of course, being a hard landing, and that is the Fed's got more work to do, or at least is going to have to keep rates higher for longer, and that's going to risk the economy going into a recession at some point. So let's look at a little bit more data to try to get a handle on which of these stories we think is sort of most likely, given what we've observed over the last month or so, and especially with the data today. So let's start with earnings. So I mentioned that the earnings numbers were pretty good. So you can see that there in that far right bar, that blue bar. So better than the last 3 months, not quite as good as what we saw over the summer, but clearly at or above the trend that we've seen over the last year or so. And if we look at it in sort of a annual basis, we've got earnings growth of about 4% a year. Now that's if you consider the Fed's target of inflation of 2% a year, that's quite a bit higher. That's fine. It's nice to have higher wages, but they need to be higher wages that are justified by increases in productivity. And productivity has been a bit of a conundrum. If we think about the aggregate weekly hours index, so this is essentially how many total hours are being worked, and then we look at that relative to gross domestic product, which is all the stuff that's being made, all the goods and services produced in the economy. We were seeing that hours were, considerably higher than output, and so that's a sign of low productivity or bad productivity gains, or even a fall in productivity. So that's, looking at this period here during 2022, when hours were growing more rapidly than GDP. But what we've seen just recently, and especially in the most recent GDP numbers, and we just got productivity data this week, suggesting that the economy has moved back to a position where output is growing more quickly than hours, and so that's a sign of increasing productivity. So I think we can sort of safely say, okay, productivity was bad in 2022. It's improving in 2023. Is it going to improve at a rate that would allow us to have wage gains of 4% going forward? We saw productivity growth in the second quarter and likely in the third quarter that would be consistent with that. But those were very high productivity numbers compared to long run history, and especially compared to what we saw in 2022. Okay, so let's talk about then where does the Fed sit right now? When you think about what affects economic decisions, it's real interest rates, real in the sense that they're adjusted for inflation. And because inflation was so high and the Fed was so behind the curve, real interest rates were very low, in fact, very negative in 2021 and early 2022. As inflation has come down and the Fed has raised rates, we finally moved back to a position where real interest rates are positive, and now right around the 2% range. So that's a big difference. I mean, there's a big difference between minus 5% and plus 2%. That's a huge swing in real interest rates. We're starting to see that obviously have effect in things like the housing market. But 2% still not super high. If you go back to the cyclical highs prior to the global financial crisis and prior to the Gulf War recession in 2001, and even going back to the late 80s, those were real interest rates that were up above 2%, well above 2%, in fact, above 3 and 4% in some cases. So while the Fed is certainly in a tighter position now than it was, last year or 2 years ago, or even before the COVID pandemic, it's still not super tight by historical standards. All right, so what's going on in the economy on the real side? Let's dig into a little bit more detail there. It's clear that there's been a slowdown in manufacturing. If we look at this, the Purchasing Managers Index of manufacturing sentiment, essentially asking businesses how things are going. Numbers below 50 mean that the industry is contracting, and that orange line below 50 is consistent with manufacturing being in a bit of a slow spell. And it's been that way for a year now or so. In contrast, services continue to grow. There was a little bit of a dip down to 50, but we're back into sort of a healthy positive range for services. So what does this mean? I mean, I think this is a sign of a generally healthy economy. We know services is a much larger part of the economy than goods and manufacturing in the US. We also know from looking historically that there's been quite a few times where manufacturing has dipped into contraction, yet the economy as a whole continued to grow. So just look at the period after global financial crisis. So, we saw dips in the 2012 range, 2015 range, bit of a dip, prior to COVID. That the recession that happened in COVID was obviously, caused by COVID and not, by sort of organic softening in the economy. And so we definitely have these periods, even going back to 2003 or so, where we see manufacturing dip, but then it comes back without the economy going into recession. So while slowing in manufacturing is definitely a drag on overall economic output, it's not a surefire sign that we're headed for a substantial slowdown or a recession. And in fact, with services holding up and continuing to be in growth mode, I think that's a sign that economic growth, at least currently, continues to be strong. All right, so let's talk about inflation. I mean, inflation's been such big news for the last couple of years now, and if we look at core PCE, so this is the personal consumption expenditure deflator. This is the Fed's favorite measure of inflation. And we can look at it here in this graph in sort of three different ways. Like what's been happening over the last 3 months annualized, that's the blue line. What's happened the last 6 months, again, annualized, that's the orange line. And then year over year, that's the green line. So, inflation has been coming down. It's been decelerating. And it's been doing that increasingly, and that's why the blue line is below the orange, and the orange is below the green. So from this, it looks like sort of short-term trends, and the overall broad kind of core inflationary categories that Fed cares about is done exactly what the Fed had hoped it would do. And at the same time, while avoiding a recession. So, problem solve. Fed can go have a great time over the holiday break and not worry about inflation, right? I'm going to make the case that it's not quite that simple, that we need to dig in even more to what's happening with inflation to really get a good, solid understanding of what the current trends are. Saying that 3-month annualized inflation has come back down to around 2% or just above 2% is, probably a overly rosy view of what's happening to inflation dynamics. So part of that story has to do with the difference between goods and services. So we've already said that goods in manufacturing has slowed a bit in the US. And in fact, we can see this in the price data. So here the orange line is year over year change in goods prices, excluding food and energy. So food and energy are super volatile. Again, it's not that we don't care about food and energy. It's just they add a lot of noise to the analysis. So what's been going on with goods? We know that there was this supply shock that came with COVID, deglobalization, all of these things we've been talking about for, several years now. Those are unwinding, right? And inflation in goods has come way down. It's basically back to zero on balance. But that's the normal state of affairs, right? If we go back, for a decade and look at what inflation in the goods sector has been, it's been negative. And that's because we just get better and better at making stuff or importing it from people who are making stuff. And so the general price trend for goods is negative. Okay, so going back to a negative or zero or negative inflation for goods, core goods is just the normal state of affairs in the economy. What we really need to be keeping a close eye on is what's happening to services, and services in this case excluding energy, again, because energy is really volatile. And here we have seen a deceleration in prices, right? So these kind of core services inflation, peaked out around 6%. And has come down to around 5% or so, but that's still really high, right? I mean, 5% is still really high. And so I don't think the Fed is going to be happy, longer term, unless this continues to come down. And so then we got to wonder, okay, is that blue line trending down going to continue? And I think that's up for debate. So this is a busy table, but what it does is it digs into more detail for the inflation numbers, so we can see exactly where things are strong and exactly where they are weak, and get a better handle for what exactly might be happening to inflation component by component. So again, the goods numbers are pretty noisy. So what I've done here, the first column is sort of the 12-month trend, but then I've taken what happened 4, 5, and 6 months ago, so April through July, compared that to what's happened in the last 3 months, July through October, because we don't have the November inflation data yet, and then said, okay, what happened here with the trend? So PCE inflation went up from 1.8% to 3.2%, so that's a positive trend. That's up 1.4%. So that's trending in the wrong direction. But that doesn't really tell you too much about what's going on, right? Because we look at that, goods is a big chunk of that. Goods went from negative to positive. Okay, what's accounting for that? Well, a big chunk of that was actually energy prices, right? We go down and we see that over this time period, we went from big deflation in energy to big inflation in energy. So we really want to kind of strip that out. When we strip that out, then we see essentially no trend in PCE excluding food and energy. It's gone from 2.6%, 2 quarters ago to 2.4% 1 quarter ago. So that's flat. So that's kind of consistent with the graph I showed you before. So goods, trending in the right direction, definitely helping headline inflation. But let's understand what's happening in more detail with services. Services are still really high, right? So inflation is still 3.4%, well above the Fed's target of 2. They'll tolerate 2 and change because of deflation in goods prices. But then let's dig inside of that, right? So housing is a big part of it. Housing is really still quite inflation prone. We know that there's a huge deficit of housing in the US. Single family housing, we're probably short 3 to 5 million units, which is several years worth of building activity. We know that there's just tremendous pent up demand. The existing home market is essentially frozen because people don't want to give up their low mortgage rates. And so there's continues to be very strong inflationary pressures in housing, which is a huge chunk of overall inflation. Now, the way these data are calculated is sort of weird, and you end up with false, sort of persistence and trends in this. But if anything, the trend is in the wrong direction, right? The trend here over the last 2 quarters has been to higher housing and utilities costs, not lower costs. If we look at healthcare, it's the same thing. So healthcare has gone from 2.67% on an annual basis, but then over the last quarter, it's picked up again, right? And we look at transportation services, same thing, picking up again. Now it's not all bad news, right? We've seen restaurants and hotels decelerate. We've seen financial services, insurance decelerate. Other services seem to be well under control, but these really big ones, housing and healthcare and transportation services, are sort of now trending in the wrong direction. So, in my mind, this says, the Fed, may not be such a friend to the markets as markets seem to believe right now. The bond market's been on a big rally over the last month or so, with rates, long-term rates, coming down almost a full percent. A little bit of reversal today on this news, as you might expect. And so I think there's this question of the soft landing, right? We're still circling. We're still, at 30,000 feet. We're not even anywhere near landing right now if you take the employment data at face value, especially the household survey. So that means the Fed's going to have to be higher for longer. Maybe they're not even done yet. Who knows? Right now, clearly there's expectations of Fed cuts next year, but are those reasonable? Or are those coming because the bond market thinks maybe there's a potential for a hard landing? And I would say I'm really surprised at what the stock market is doing. And I personally wonder if there isn't sort of some excess sentiment. The one thing I like about Bitcoin is I think it's a great measure of retail sentiment. And this big rally in Bitcoin suggests to me that there may be some amount of irrational exuberance in the stock market. So is the bond market forecasting a soft landing or a hard landing? I don't know. It might be a hard landing, and that might be really disappointing for equity investors. But there's clearly more to the story in inflation than just looking at what's happening in the headline numbers. All right, so I'll leave it there. Maybe a little longer than I was hoping for, but Rob, happy to take any questions now.
Okay to go long when the insights are that great on such a wide variety of topics in such a short amount of time. So all good there. We've got a couple of questions, so let's go straight to those. Chris Faulkner McDonough says, how large of an increase in labor force participation do you think we need to see for the Fed to feel comfortable with the labor market? Since retirements have been a big driver of the post-COVID weakness in the labor force, where should we look to see if enough people above the age of 55 are re-entering the workforce?
Yeah. No, that's a very interesting question, because the deficit relative to pre-COVID right now is in this over 55 group, right? And a lot of those were people that left the labor market, and they probably left for good. I mean, a large chunk of them that left for good. So how do you get back to something that's more consistent with historical norms? It's a waiting game. You got to wait. You got to wait for people who are 54 to turn 55, right? That's how those numbers go up, right? I don't think it's going to be from people literally unretiring and coming back to the labor force. That's going to be a pretty small contributor. So that's a waiting game, right? That's literally waiting years and years for those numbers to get back up to where they were pre-COVID. So I don't see there being a huge increase in the labor force coming from that over 55 group. We are seeing encouraging growth in the rest of the labor force in numbers that are well above what we would expect from recent trends. There's sort of these very long run secular trends that it's hard to unpack exactly what's driving those. That's not my area of expertise. Maybe we get Paige to weigh in on those and what she thinks at some point. But I mean, I think the news is good, and certainly the news was good in terms of labor force participation this month, with 500,000 people coming into the labor force. But that doesn't make the Fed happy from an inflationary standpoint, having 500,000 people come in if you've got 750,000 people taking new jobs, right? Because then the unemployment rate's trending down by definition. And that's going to make them nervous about the economy being sort of overheated or above its productive capacity.
Okay, thank you. This one's from Barbara Senich, and she thanks you for your always nuanced and yet digestible analyses. So a good way to lead. Total employment, of course, she says, drives consumer activity, purchases, savings. That said, I always wonder if we should think about government employment, which uses taxpayer dollars, to create employee savings and purchasing power, differently from private sector employment, which creates taxable corporate revenue as well as employee savings, purchasing power. The economy needs both, of course. Any thoughts on that?
Yeah, I mean, I think we do need both. As a state government employee, I can tell you there are a lot of empty jobs in state government right now, and even here at the business school, because it's been hard for us to hire. So I think there is going to be kind of improvements in output, real economic activity that comes from filling some of these jobs. So hopefully our line at the DMV is shorter in the future, and we can all be productive instead of spending a half day in line getting our driver's license. But that said, I mean the productivity of government employees is lower than the private sector on average, and so all is the same, you'd probably rather have private sector employment than government employment if you're trying to maximize the size of output. But I think it's fine, right? What's happening right now, it does feel to me a lot like these sectors, like leisure and hospitality, and the government, and healthcare, that have been so starved for employees, are finally able to bring folks back in. And I think that's a good thing. If you think about it from a wage perspective, I mean, what drives consumption? It's wage growth. Getting paid $1 from the federal government or the state government is the same dollar that you're getting paid if you're a private sector employee. So, when we think about the aggregate purchasing power, it doesn't matter so much where those dollars come from.
Okay, very good. And you do sound like a man who's visited the DMV recently, but I'm just...
No, I'm dreading it, actually, because my license expires in January.
All right, you're working ahead of that one.
I'm building a tactical plan.
Yes, very good. Excellent choice. And that might be worth a commentary or something that can help people out on the website. One more quick one. Anything that Triangle area CEOs might take away from this report that jumped out at you?
Yeah, I mean, we will definitely be digging into the regional data, with our AGP type work. I mean, I think we saw, if we think about sort of important sectors, in the Triangle, obviously healthcare sector is important. And so, that sign that we're seeing more employment growth there is good. For that same reason, maybe we're getting back to an equilibrium. Tech seems to have stabilized, right? So, while we saw tech losing jobs, over the last year or so. That seems to have stabilized. So that's good news. And I mean, overall, I think the triangle is still going to have to import jobs, import people to fill jobs. I mean, our growth rate continues to exceed our kind of organic, demographics here in the triangle. So, we'll continue to be importing people to meet labor demand.
Okay, very good. 9:31, so we better close this party down. But thank you, Professor Greg Brown. Always a pleasure to have you on here. And I should mention Greg is though he's not executive director anymore, he still has a lot to do with Kenan Institute through our Luther Hodges Scholars, through IPC. So it's not like we don't see him anymore. But great to have you back. Thanks very much.
Yep, my pleasure.
Thanks also. Oh, wait, I got one question right at the end here. Oh, nope, that was just a thank you. Never mind. We're good. It's okay. Thank you, everybody who attended today. We appreciate your attention and we appreciate your questions. They make the show go. For everyone in the media out there, please know that we'd love to continue the conversation. If you'd like to talk to Professor Brown about any of the topics he talked about this morning, or any of our other experts on the wide variety of topics we cover, please reach out to me, Rob_Knapp at Kenan-Flagler.unc.edu. For all of you, we would welcome you to check out our website at kenaninstitute.unc.edu. A couple of things to look for. There are a couple of recent commentaries on inflation that touch on some of the things that Greg did this morning. In fact, one of them will go up today, so you're getting a little heads up on that one. We'll have links for those in the emails that go out to you all early this afternoon with the link to the video, so keep an eye out for that. Also, Greg mentioned American Growth Project, and this is sort of a save the date or save the month, but we will have more from the American Growth Project coming out in January, so be sure to keep a lookout for that. Also, a quick thanks to the behind-the-scenes folks today, Cody Morris, who handled all the graphics, and Robbie Passel, who did double duty on pushing the Zoom buttons and doing the video editing, which is yet to come. Thanks to you both. Thanks again to everybody. We hope to see you on January 5th, the next time we'll be doing this after an employment report comes out. So, hope to see you then, but until then, have a great Friday. Thanks.